Hey, so this is lesson 3, and this is all about how to value an apartment complex. So you might be asking yourself, why in the world are we going to be talking about valuing an apartment complex? But what I'm trying to do in this lesson is really two main things. The first one is I want to give you the basics into intrinsic value calculations. So what we're going to do is we're going to take a generic business like an apartment building, and we're going to figure out what the value of that apartment building is based on some of the math. The other thing that I'm going to do in this lesson is teach you some of the basic key terminology that you need to know in order to do this successfully. So what I'm going to do, and just so you understand a little bit of my background, so my father was in the real estate business, and he taught me a lot of amazing things with the way that he thinks through the valuations of things whenever he was buying buildings and running his business. So what I want to do for you is kind of give you the basics of what I learned as a kid on how to think through some of this stuff whenever you're trying to determine the value of a business. So let's just take a generic apartment building with 20 units. So there's 20 people living in this apartment building. And let's just say that the average monthly rent is $500 per month. So each one of those units will bring in $500 per month. And so if there was 100% occupancy, that would be $10,000 a month that this apartment building would bring in. To add a sense of realism to this, let's just say that the occupancy rate of the apartment building is 90% occupancy. That means that at any given time, 90% of all the units inside of the apartment building are actually rented. So that means that under that situation, the apartment complex would bring in $9,000 a month based on those figures. So this number is important because this is what we commonly refer to as the top line. This is the revenue. This is the number. This is the raw number that comes into the business before all the expenses and everything else is paid out. And that's why it's called the top line. So if the business was making $9,000 a month, we could then say that in 1 year, on average, this apartment complex would bring in $108,000 a year. And we're going to talk about things in a per year basis from here on out. So once we figure out what that top line number is, and that's how you should always think about this. And if you want to look at what the top line is for any stock on the stock market, it's called the income statement that you'd go to. And if you went to the income statement and you literally went to the very top line, the number that was clear at the top, that's what we just calculated. That's what we just figured out for this apartment complex. So if it was for Coca-Cola, you could generally think that that top line number is if you added up all the Coke cans. If the average sales price of a Coke was 50 cents, that price times the quantity would be that top line number for a company like Coca-Cola, just so you can kind of visualize that for a real stock. So once we know what that top line number is for our apartment complex, it's $108,000 a year. Now we can take that number and amend it for the expenses that we have to pay out for that year. And then we're going to see what's left, or the profit that's left at the end of all of that. So I'm just going to throw out a couple of expenses. There's a whole lot more that we could really kind of look at here. But generically, let's just throw out a couple of expenses and see what we can get to for a profit on this apartment complex. So let's say that some of the expenses are, you're going to hire a maintenance manager to basically run everything. He's going to help you get people into the rooms. He's going to perform all the maintenance. He's basically going to run the operations. So let's say that we're going to pay that maintenance manager $30,000 a year in order to do that job. The next thing that we could account for as an expense would be a depreciation expense. So let's say a hot water tank breaks, or that maintenance manager has to install more hardware like a new faucet or a new sink or something like that. So let's just say that those depreciation expenses are about $20,000 a year. The next thing that we're going to consider is marketing expenses. Say you have to run advertisements in the newspaper, or you have to hang up signs or whatever. But let's just say that those marketing expenses are $5,000 a year. Then finally, you have to consider as a generic expense, let's just say your interest expense on the loan that you took out in order to buy the property. So let's say that that interest expense is around $20,000 a year. When we add up all of those expenses, those come to a total of $75,000 in expenses. So now, once we have this generic income statement, and that's the proper terminology for this, you've got $108,000 on the top line, which is the money coming in, and then the money going out, which would be all the red, is $75,000. So when we compare those two numbers, the top line, which is the green number, and all the expenses, which is your red number, you come up with $33,000 in profit that's left over, and that goes into your pocket as the owner of that apartment building. So that profit, this is really important, this terminology here. So that's the profit that the business is making per year, and this is called the net income, or the bottom line. The bottom line on the income statement is your profit. So if that number is negative, that means you're losing money. If the number is positive, that means you're making money. So the reason why this number is really important, and we talked about this a little bit in the second lesson, from that profit, from that net income, that's where the dividend will get paid. Anything that's left over that isn't paid as a dividend is retained in that corporate cash account, in the bank account for the company. So let's talk about some of the concepts we learned in lesson 2. So let's say that $33,000, let's say half of that is paid to the owner as a dividend. So we'd be looking at something like $16,500 would be paid to the owner as a dividend. The other $16,500 would be retained in the company's name, in the company's bank account. And then that money could be used to expand the apartment complex, maybe build another building, depending on how much other cash is left in that corporate account. But that money could be used for whatever that person, whatever that manager wanted to do, or the owner wanted to do with that money that would be retained by the company. Think of it like this. The owner of the equity of this building, of this apartment building, he owns all $33,000. But the way that it's split up is whether it's put into his personal private bank account or it's retained in the corporate bank account, which he owns. He owns that corporate bank account. That's a really important thing to understand if you own all of the equity. Now let's talk about how you would determine the value of this apartment building. And this is the part that I think is really important for people to understand. So when you start talking about how to value this business, it all comes down to how much is somebody willing to pay in order to receive that $33,000 of profit every year. So if you had a money machine that could only print $33,000 a year because the speed is slow, or however you want to perceive that, but if you were going to buy a money machine that would print $33,000 a year and put it into your pocket, how much would you be willing to pay to own that? And so this is where, when we say that the intrinsic value of a company is the amount of cash that it will produce into the future, discounted back at an appropriate discount rate, this is where the discount rate discussion starts to occur. Not to confuse terminology here, but when you're talking about a discount rate in specifically real estate, they call that a cap rate or a capitalization rate. They mean the same thing. Don't get those two confused. But a cap rate in real estate is a discount rate. And so for each area that you would go to around the US, they have different cap rates. They have different discount rates for that region. So if you lived in Miami, it might be completely different than the cap rate that you would find out in LA, or the discount rate that you would find out in LA. But for simplicity, let's just say that the discount rate or the cap rate is 10%. So if the discount rate or cap rate is 10%, that means that you would pay 10 times the profit to buy the business. So, and I'll show you real quick the rule of thumb for determining that 10 times. So if we're paying 10 times the earnings in order to own the business, that means that the company that made $33,000 in profit might be worth $330,000 if it was going to be sold to another buyer, assuming a 10% discount rate or cap rate. This whole scenario is really important for you to understand, because this is exactly what we do with stocks when we're trying to determine what the value of a stock is. What I think is really important to illustrate here is as that discount rate changes, so does the value of the business. So before, when I say a 10% cap rate or discount rate, what I'm doing in order to get 10%, you have to figure out what the ratio is. So if you go 1 divided by 10, that'll give you 10%. So always remember, it's 1 over some number that gives you the percent. So if I take 1 divided by 10, that gives me 10%. So that means that when I go 1 divided by 10, I will multiply by the 10 to my profit. So let's say that we have a cap rate or a discount rate of 5%. In order to get 5%, I have to take 1 divided by, and the number is 20. When I take 1 divided by 20, I get 5%. So 20 now is the number or the multiple that I will multiply by my profits. So whenever I take 20 times profit of $33,000, I actually get $660,000 for the value of the business. So you can see this comparison between a 10% discount rate and a 5% discount rate literally doubled the value of the business that it could be sold for. And that is really, really, really important. One of my biggest pet peeves, whenever I hear a person say that the value of the business is $40 a share or $80 a share or whatever, my immediate reaction is, at what discount rate? And the reason that I always say that is because without knowing the discount rate that the future cash flows are being multiplied by, you can't really understand what the value even means. So, if I said the value of the business is $330,000, that doesn't make any sense without knowing what the discount rate is. So that's how all of this kind of fits together in a very generic and simple example. And I've used apartment complex to help illustrate this idea for you. So one final thought that I think is important for anyone to think about. When you associate that price with the discount rate, what that really means and what that's really saying is, if I can buy the company for $330,000 at a 10% discount rate, I should expect a 10% return on my money every year. That's the key phrase. So let's go ahead and say that same thing for the higher price and the lower discount rate. If I buy this company for $660,000, I can expect a 5% return on my money every year. And you can see how that makes sense now when we phrase it that way. So if you were going to buy a stock, let's just say Coca-Cola. If you did a discount cash flow analysis based on the earnings and the profit that the company produces, and you would say something like, I can buy this company for $40 a share at a 7% discount rate, you might expect a 7% annual return on the company by continuing to own it. So you can see how the math on this works and how you can apply it to the stock market by just trying to figure out what is the actual profit that the company's producing, and then what multiple gives me the current price that people are paying for it on the market, and then the yield that's associated with that will tell me what I could expect to get annually by buying it at that price. This is a very, very important lesson that if you didn't catch all of this, I'd tell you, go back, watch this, and watch it again until this really makes a lot of sense, because everything we're going to do in this entire course revolves around this scenario that I just described. One other consideration as you're thinking through this. In this scenario, we are assuming that the earnings are fixed, that every year you're pretty much going to make $33,000 of profit. When you're figuring out the value of a stock, it's a little bit different because you might be accounting for that profit, that $33,000, that might be growing. Your expectation for next year might be that it's $35,000. Then the year after that might be $37,000. And as that would be growing, you need to account for that in the math, and that's going to all shake out. We're going to cover that. Don't worry. But I think it's important to highlight that in this scenario that I'm describing, I specifically chose something that was fixed, like an apartment building, because it's much easier to do the math and provide a great example for you to understand how that math works before we start getting into some of the more complicated and complex ways of valuing things where you start taking into account future growth in that profit and that net income.